So is the market going to crash by March of 2025? Well, guess what? There's one U.S. trader that placed quite of a big bet, betting that there's going to be aggressive rate cuts by Q1 of 2025. And whenever we see those aggressive rate cuts, we tend to see a recession because of that. Now, there's an article here that comes out from Zero Hedge titled Market Spooked by Big Bet Fed Will Cut 300 Basis Points. Okay, that's about 3% by Q1 2025. So let's read let's read a little bit into this article. I'll also link it in the description so you can follow along. It basically says here, when someone bets a substantial amount of money on a non-consensus forecast for where rates should go, people talk. And they are talking a lot right now. After Bloomberg pointed out that a mystery trader has put a huge bet that Fed will cut rates as low as 2.25%, some 300 basis points of cuts from here by March 2025, wagering approximately 13 million that the U.S. economy is about to get rugged in the next 9 months. As Bloomberg's Edward Bolingbroke writes, over the past 3 sessions, positioning in the options market linked to SOFR, secured overnight financing rate, aka the new LIBOR, shows a surge in bets that stand to profit if the Fed slashes its key rates as low as 2.25% by the first quarter 2025. Some more details about this Bloomberg trader. It says all session 30,000 SOFR March 25 call spread bought at $4.75, says U.S. trader, and the open interest basically in the strikes has risen to 106,000 approximately, and 112,000 after same position was bought Friday, and 80,000, 110,000 over Friday and Monday session for a premium approximately 13 million. The dovish hedge sits maximum profit with the Fed rate around 2.25%, implying Fed will cut rates about 300 basis points between now and March policy meeting. Moving on, such an outcome, which envisions at least 300 basis points cuts from current levels, appears unlikely unless the U.S. economy tumbles into a sudden recession. So here's the thing, right? We've heard of some of these stories also previously coming out from Zero Hedge and Bloomberg, of big traders making a big bet, shorting bonds aggressively, going long bonds, etc., hedge funds blowing up back in March of last year when there was a regional banking crisis that occurred, right? Those news come and they go. Now, the fact that this trader is betting on a particular product, which is the SOFR March 2025 contract, betting that rates would come down aggressively, does it mean anything? Well, maybe not. No one truly knows. Maybe that person has a very a big long position along with this bet. Betting in maybe the equity markets, and is hedging that with this trade, right? We don't know exactly what's the true intention. If let's say there was a sudden recession, a sudden crash, then yes, this trader will be paid out quite handsomely on that position. The other thing is, does this trader have inside information that we don't, right? We've seen this previously also when I looked at back then when it was the LIBOR contracts. We saw quite the increase in the prices in those contracts before COVID happened. And lo and behold, when COVID hit, we heard many news of many top level, executive level managers coming out and saying that they sold their stocks before the crash, right? Because they were notified on the news. Same thing, many politicians did the same thing before the massive COVID crash. So sure, it's important to watch these products because some of these guys, it's not fair, but they have inside information, right? Now, does this particular person have inside information? Maybe, maybe not, right? When I look at the SOFR contracts and when I look at the bond market and the yield curve, yes, this is particularly to one type of contract and product, but when you look at the whole curve, when you look at the whole bond market, it doesn't look like people are placing those bets or are very worried right now. Only time will tell whether this person is right or wrong, but I wouldn't sound the alarm right now until I see evidence, more signs in the bond markets to say, okay, yeah, we're headed towards more rate cuts and aggressive rate cuts eventually. Until then, right now, there's nothing major, but something to keep an eye out on, something to track, something to see as well. Another thing I want to also point out is that the positioning for a lot of these CTAs and these hedge funds they're still short, massively short bonds. So that could be interesting if things turn around and there was a sudden recession. You could see a massive short covering rally causing bond prices to skyrocket and those yields to come down lower. So very interesting. Check it out. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers. Bye.